Price stability is the bedrock of a healthy economy and provides the public with immeasurable benefits over time. But restoring price stability when inflation is high can require measures that are not popular in the short term as we raise interest rates to slow the economy.
That was Fed Chair Jerome Powell in a speech yesterday outlining the sometimes unpopular decisions the Fed has to make to stabilize prices. Our next guest says the divergence between where the market thinks rates are and where they're heading and where the Fed does will be the cause of increased volatility through the next several months. William Blair, macro analyst. Richard de Chazal joins us now. Great to have you here with us this morning. Help us break that down just a little bit more and what the markets are reading into what Fed Chair Jay Powell is saying.
Hi, good morning. Yeah, thanks for having me on. So, I think there's this kind of dichotomy between the market and the Fed at the moment, where the market is looking at all of the real economic data, the ISM, small business sentiment, and seeing that it's all kind of leading to weakness, and that should be followed through with inflation. And we are actually already seeing the inflation coming down. We've seen some slowdown in the momentum there over the last couple of months. And we have some inflation data coming out tomorrow, which I think the market will be looking at to confirm that sentiment. On the flip side, though, I think the Fed has a slightly different problem on its hands. It'll be happy to see clearly any moderation in inflation, but from its perspective, it's got a bit of a credibility problem on the one hand. So it doesn't want to get overexcited about any slowdown in the inflation numbers and then have inflation pick up a little bit later on in the year and then kind of be caught on the back foot once again as it was last year. A second problem I think the Fed has is it's as long as the market is kind of pricing in a pivot or a pause, that helps to bring down financial conditions or ease financial conditions, which is the main channel through which the Fed's monetary policy acts. And any kind of premature easing in the financial conditions then takes some of the weight off what the Fed is doing. So the Fed clearly wants to keep the market expecting rates to be higher, pushing up above 5%. And the market right now is kind of pricing in rates staying just below 5%. So you're kind of getting this tug of war going on between the two.
Richard, when do you think the economy will start to show tangible signs of the Fed's rate hikes from last year? And what do those impacts look like?
So I think it's just starting to show. I mean, Powell likes to say, and we've heard a lot about long and variable lags of how monetary policy operates through the economy. And I think, the initial stage of higher interest rates, we saw a lot of that taking place last year. That was really through financial markets. So we saw a big correction in financial markets. And then the sort of second phase, I would say, is really in the most interest rate sensitive sectors of the economy. So housing, autos, that kind of thing. And we really have seen a big correction in the housing market already. We're waiting for that to start to filter through into the inflation data. So looking at tomorrow's inflation report, the shelter component will be a very important part of, are we starting to see that starting to the real economy data starting to filter through to the inflation part of that. And I guess the third part, is we haven't really seen much yet. And that would be kind of on wages, labor market, those sort of areas, kind of coincident to lagging indicators of the economy, which have been a lot slower to feel the impact of those rate increases just yet. And I think Powell is kind of alluding to this, that this is not an economic cycle that is being driven by a pandemic or a financial market crisis where all economic indicators and inflation are really, coming down at the same time. This is a cycle that's seemingly driven by income growth, excess stimulus, and a Fed that is now having to come in, break that cycle, raise interest rates. And that has an impact that's kind of rolling across the economy at different periods. And I think what the Fed has been looking at is inflation and in three different buckets, the first being goods prices. So as I alluded to earlier, we've had the opening up of the economy, supply chains improving, and those goods prices have been coming down quite significantly, used car prices, for example. The second component, shelter, as I mentioned, housing, that's kind of rolling through now, and we're starting to see shelter components having a more moderating impact on inflation. And the third component, which Powell has really highlighted, has been this core services, less shelter component, which is kind of the stickiest component of inflation. That's really driven by domestic demand. It's driven by wage growth. That could be things for like prices for haircuts. And the Fed is really wants to see those coming down in a more meaningful way before it really feels confident that it has squashed the higher inflation for the time being.
Well, we'll see if we get some signs of any of this when we get that data tomorrow. William Blair, macro analyst, Richard de Chazal, thank you so much. Appreciate it.